Hi, welcome back. If you were watching the silver market just a few weeks ago, you probably heard a very confident claim floating around. People said silver was finished. They said the run was over, and anyone still holding it above $55 was simply hoping for a miracle. It's easy to understand why they thought that. Silver had fallen hard from its all-time high, cutting through the $60 level, and kept finding new lows in that $55 to $57 zone. But then something happened that those confident voices did not expect. Silver didn't just bounce a little. It surged back above $62, on the back of one of the most closely watched economic reports in the country. Today we're going to walk through exactly what happened, why it happened, and what the data underneath is actually telling us. When you separate the noise from the numbers, this story looks a lot more interesting than a simple dead cat bounce. Let's start with why this moment actually matters. Even if you've never bought an ounce of silver in your life. Silver sits at an unusual crossroads between being a monetary metal, something people hold as a store of value, and an industrial metal, something factories need to build solar panels, electric vehicles, and electronics. That dual identity means silver reacts to two very different forces at once, which is part of why its price swings can feel so dramatic, and why a single piece of economic data can move this market so sharply. So here's what actually happened. The United States released its June jobs report, and it came in soft. Employers added only 57,000 jobs for the month, well short of what economists were expecting, and the weakest hiring number in about 4 months. Hiring figures from earlier months were also revised down, telling the market the labor picture had been weaker than originally believed. Here's the twist that made this report even more interesting. The unemployment rate actually ticked down to 4.2%. At first glance, that sounds like good news. But the drop happened mostly because fewer people were actively looking for work, not because hiring picked up. Think about it this way. If 10 people are looking for a seat and only 7 are seated, that looks bad. But if 3 of those people give up and walk away, suddenly it looks like 7 out of 7 are seated, and the math looks fine even though nothing actually improved. That's roughly what happened with the participation rate, and sharp eyes in the market picked up on it immediately. Now, this is important because of what this kind of data does to interest rate expectations. Before this report, traders were leaning toward the idea that the Fed might need to raise rates again to keep inflation in check, with odds of a hike sitting fairly high. A weak jobs report changes that calculation fast. When hiring slows, the Fed has less reason to tighten policy because a slowing labor market naturally cools spending and inflation on its own. Almost immediately after the report, the probability of a rate hike dropped sharply, falling to near 50% from odds well above 60% just days earlier. That shift matters enormously for silver, and here's why. Silver, like gold, doesn't pay any interest or dividend. When rates are expected to rise, holding cash or bonds becomes more attractive because you're getting paid to wait. But when hike expectations fade, that advantage shrinks, and non-yielding assets like silver suddenly look more appealing by comparison. Let's break this down with a simple mental model, because this is the piece that trips a lot of beginners up. Picture 2 friends deciding where to put their spare cash. One option is a savings account paying a decent guaranteed return. The other is a chunk of silver that pays nothing, but might appreciate in value. When the savings account is paying well and about to pay even more, most people lean toward the safe option. But the moment that rate looks like it's about to freeze or shrink, the appeal shifts toward the asset that doesn't rely on someone else's promise to pay you. That's the tug-of-war happening constantly between interest rate expectations and precious metals prices. And it's a big reason silver moved the way it did after this report. There's a second piece to this puzzle, just as important as the interest rate story, and that's the US dollar. When rate hike expectations fall, the dollar tends to weaken, because foreign investors get less incentive to hold dollar-denominated assets for that extra yield. Silver, like most commodities, is priced globally in dollars. So when the dollar weakens, silver automatically becomes cheaper for buyers holding other currencies, whether that's the euro, the yen, or the yuan. Cheaper prices abroad tend to pull in more global buying, adding extra fuel to the move. In the days following the jobs report, the dollar had one of its weaker weekly stretches in months, and that lined up almost perfectly with silver's push through $60 and then $62. Now here's where the story gets even more interesting, because price action alone doesn't tell you whether a rally is built on solid ground or just short-term panic buying. To understand that, you have to look at what's happening underneath the surface, in the actual physical and futures markets. This is where the phrase short squeeze comes in. So let's unpack it in simple terms. In the futures market, traders bet on where price will go. Some bet it will rise, called being long. Others bet it will fall, called being short. When a market has a large number of short positions and price suddenly rises instead of falling, those short sellers start losing money quickly. To limit losses, many are forced to buy back the metal they bet against, and that buying itself pushes price up further. It becomes a chain reaction, rising prices forcing more buying, which pushes prices up more, squeezing anyone who bet the wrong way. This differs from a rally built purely on optimism, because it's driven partly by traders being forced to act, not just choosing to. But here's the part that really separates this move from a temporary panic spike, something a lot of people missed while staring only at the price chart. Look at what was happening with actual inventories. Registered silver sitting in COMEX warehouses, the certified physical stockpile backing the futures market in New York, had fallen to a cycle low earlier in the year, dropping into the mid-70 million ounce range. That's meaningful, because it suggests real metal was being pulled out of storage and used or delivered, not just sitting there as a paper promise. Since that low, COMEX inventory has climbed back into the low 90s, the highest level in months. Warehouse stockpiles tracked on the Shanghai Futures Exchange tell a similar story, also crashing to multi-year lows before staging a real recovery, even though they remain historically tight by longer-term standards. Think about what that means together. If silver were truly dead at $55, if demand had genuinely dried up, you would expect those inventory levels to keep sliding or at least sit flat. Instead, warehouses on two different continents both showed signs of physical metal moving, hitting lows and then recovering. That tells you something important. Buyers, whether industrial users, investors, or institutions, were still actively engaging with the physical market even while prices sat near multi-month lows. That's not typically what a dead market looks like. A dead market usually shows disinterest across the board, not renewed physical activity happening quietly while headlines focus on falling prices. At the same time, it's worth being honest about the other side of the ledger, because a balanced view means looking at the full picture. Silver-backed exchange-traded funds, the paper investment vehicles that track the metal's price without requiring anyone to hold physical bars, actually saw holdings decline over the same period, dropping to their lowest in about a year. That tells us some investor money was leaving the paper side even as physical inventories stabilized and recovered. This is an interesting divergence, suggesting that certain investors, likely those with a shorter time horizon, were stepping back, while others, possibly closer to the physical supply chain, kept engaging. It's a reminder that no market moves as one unified block. This feels like a good moment to pause for something unrelated to price predictions. If you've made it this far, you're clearly someone who wants to actually understand markets rather than just chase headlines, and that's exactly the kind of viewer this channel is built for. If that sounds like you, tapping subscribe helps a lot, and a quick like lets more people see content like this instead of the noisy, fear-driven stuff that dominates search results. No pressure, just genuinely appreciated if you find this useful. Now let's keep going. Let's talk about the gold-to-silver ratio, one of the simplest tools for understanding how these two metals move relative to each other. It measures how many ounces of silver equal the value of 1 ounce of gold. When silver rallies faster than gold, the ratio compresses. When gold outpaces silver, it expands. During this recent move, the ratio compressed, meaning silver gained more in percentage terms than gold over the same stretch. Historically, a compressing ratio during a broader metals rally has often signaled renewed investor interest specifically in silver, since it's seen as the more volatile, higher beta play on the same story lifting gold. It's not a perfect predictive tool, but it helps frame how silver behaves relative to its sister metal. Now let's zoom out to the bigger backdrop, because silver doesn't move in isolation from the rest of the world. Earlier this year, tensions between the United States and Iran escalated into open conflict, sending ripple effects across commodity markets, including oil and precious metals. As shipping through waterways like the Strait of Hormuz faced disruption and then gradually recovered, energy prices shifted, influencing inflation expectations. Lower oil prices helped cool inflation worries, part of why Fed officials sounded more measured recently. Fed Chair Kevin Warsh speaking at an international forum around the same time as the jobs report, noted that inflation expectations had eased somewhat, while still emphasizing the central bank's commitment to price stability. That combination, softer inflation pressure alongside softer hiring data, is exactly the environment that tends to support precious metals, because it reduces pressure on the Fed to keep policy tight. Here's a simple framework for making sense of silver's price movements going forward. 3 forces working together rather than any single cause. The first is monetary policy expectations, what people think the Fed will do with interest rates. The second is the US dollar's strength or weakness globally. The third is the physical supply and demand picture, what's happening with mine production, industrial usage, and warehouse inventory. When all 3 forces point the same direction, you get the sharpest, most convincing moves. When they pull against each other, you get the choppy, sideways price action that makes headlines about markets being dead. What we saw around this jobs report was a rare moment where 2 forces, rate expectations and dollar weakness, lined up cleanly in silver's favor, while the third, physical supply, was already tightening beneath the surface. Now let's talk honestly about where things could go from here, because responsible investing means considering more than one outcome. On one hand, if upcoming inflation data comes in hotter than expected, or the labor market shows unexpected strength in future reports, the Fed could sound more hawkish again, likely pressuring silver back down toward $60 or possibly lower, toward that $55 to $57 zone where it previously found support. Some analysts point to resistance sitting in the $62 to $65 range, meaning the metal may need a fresh catalyst to push meaningfully beyond that zone. On the other hand, if incoming data continues to soften and the dollar keeps drifting lower, there's a reasonable case silver extends its recovery further, especially if physical demand indicators keep improving. The honest answer is nobody knows for certain which path plays out, and anyone claiming certainty is overstating their confidence. What we can say is that the underlying data paints a more nuanced picture than the simple headline of silver being finished at $55. So why does any of this matter for you, sitting at home maybe not even actively trading commodities? Because this same tug-of-war between interest rates, currency strength, and real-world supply and demand touches nearly every corner of your financial life, whether that's the return on your savings account or the value of retirement accounts holding exposure to precious metals. Understanding how these pieces fit together gives you a clearer lens for reading financial news generally, not just silver headlines. The next time a jobs report crosses the wires, you'll have a better sense of why markets react the way they do, and you won't be as easily swept up by the panic or euphoria that tends to dominate financial media. Let's bring this all together. Silver fell hard from its highs, spent time consolidating in the mid-$50 range, and plenty of voices declared the story over. But a weaker than expected June jobs report shifted interest rate expectations, weakened the dollar, and triggered a short covering rally that pushed silver back above $62 within days. Underneath that move, inventory data from both COMEX in New York and the Shanghai Futures Exchange showed genuine physical recovery after hitting multi-year lows, even as ETF holdings told a more cautious story on the investment side. None of this guarantees where silver goes next, and it's not a signal to rush into any decision. But it does show that declaring a market completely dead based on price alone often misses the fuller picture hiding in the data underneath. Keep watching the actual numbers, stay skeptical of overly confident predictions in either direction, and keep building your own understanding one piece at a time. Thanks for watching, and I'll see you in the next one.